Bitcoin is once again sitting in the extreme fear zone. Historically, that label has marked some of the best accumulation opportunities in crypto history. But what's happening in 2026 feels structurally different, and that's what we need to understand. Let's rewind. In 2012, Bitcoin collapsed to $7. During the Mt. Gox crisis, price fell to around $421. The 2018 bear market bottomed near $3,100. The COVID panic low came at $3,852, and the FTX-driven collapse flushed price to $15,600. Every one of those moments aligned with extreme fear. Retail capitulated. Institutions were largely absent. Government support was non-existent, and eventually powerful rallies followed. Now fast forward to February 2026. Bitcoin printed a low near $60,000 while sentiment once again sits in extreme fear. On the surface, that sounds bullish. Historically, fear extremes have aligned with major bottoms. But here's the key difference. Today's market is dominated by institutions, ETFs, and macro liquidity cycles. This is no longer a purely retail-driven market. The Fear and Greed Index mostly reflects retail emotion. But Bitcoin today is influenced heavily by ETF flows, hedge funds, macro positioning, and global liquidity conditions. That means sentiment alone may not be a reliable timing tool anymore. Here's where it gets interesting. If institutions tend to scale in gradually at discounted levels, extreme fear could simply be lagging liquidation events, not signaling recovery. In other words, the damage may already be visible, but selling pressure might not be fully exhausted. And then we have macro pressure. Bitcoin doesn't trade in isolation anymore. In risk-off environments, when liquidity tightens and broader markets weaken, crypto often follows. Forced liquidations, leverage unwinds, and portfolio de-risking can override sentiment indicators completely. Historically, the strongest accumulation phases began when even dip buyers stopped trying, when disbelief replaced hope. We may be approaching that phase, but it's not confirmed yet. Now add another layer, whale activity. A large known wallet recently deposited 5,000 BTC worth hundreds of millions into Binance. Large exchange inflows often precede distribution. It doesn't guarantee selling, but it increases supply-side risk at a fragile moment. So what does all this mean? Extreme fear alone is not a buy signal. It's a context signal. For traders, this means volatility is likely to remain high, and another leg below $60,000 cannot be ruled out if liquidations continue. For long-term investors, these zones historically become powerful accumulation areas, but timing entries requires patience and risk management. The key thing to watch now is not sentiment, it's whether forced liquidations slow down, spot demand absorbs supply, ETF outflows stabilize, and macro liquidity improves. Until then, Bitcoin remains vulnerable, even if history suggests fear zones eventually reward disciplined investors. This isn't about predicting the exact bottom, it's about understanding structure. Because in modern markets, structure matters more than sentiment. If you value clear, data-driven crypto analysis without hype, make sure to subscribe to Stick vs. Crypto. We break down the structure, not just the headlines. See you in the next one.